All right, guys, we are back and we are live. So, one of the most common questions that I get is something like this here that asks, what's the reasonable number of stocks to have in a portfolio as a beginner? Or, in other words, how many different stocks should I have in my portfolio? And it's, as many of you guys know, it's a pretty tough question to answer, but in tonight's live stream, we are going to try and dissect some of the variables that can maybe help you answer that question. It's a tough one to answer, like I said, but we're going to give it a shot. But before we get into that, welcome to another Dividend Happy Hour. It's been a few weeks. I think it's been, I don't know. We didn't do it last week. I don't know if we did it the week before. So this might be like the first Dividend Happy Hour in like 2 or 3 weeks. So super good to be back. I've been looking forward to this all day, and I'm really excited about tonight's live stream. And you guys, let's kick it off the best way, the only way we know how, with a quick cheers. So here's to the yield. I'm a little bit rusty. It's been a while. Here's to the yield. Here's to the growth. And here's to that sweet, sweet, sweet cash flow. Cheers, guys. And also here's to you. Let me know a couple things here in the live chat or in the comments below if you're watching the replay. Number one, which stocks did you buy this week? What did you add to your portfolio? Number two, what are you sipping on for the Dividend Happy Hour? What did you bring to drink tonight? Got a little, it's called a Polar Seltzer, as you guys see if I can show you here if it'll focus. I gotta maybe do that. Yeah, it's called a Polar Seltzer. No alcohol or anything like that. This flavor is pineapple guava. It's pretty good. It's I'm not a huge seltzer guy, but you know, I don't know. Sometimes anything's better than water, and I do have like a big glass of water here as well. But keeping it clean tonight. No alc for me. But also let me know the third thing, guys. Have any of you hit any cool milestones in your portfolio this week? Any new income milestones? Any new, maybe you reached 100 shares of SCHD or something like that? Any new portfolio value milestones? Anything cool happen in your guys' portfolio this week? I'd love to hear about it. I'd love to share it here up on the screen. So let me know all three of those things. And as you guys are chatting there in the live chat, which we'll go down the line here in a moment, I just want to say what's up to all you guys here. We've got Lucky in the building. We've got Mr. Zach Attack. El Dynamico is here, of course, because where else would El Dynamico be on a Friday night other than the Dividend Happy Hour? We've got Dean. We've got Reshmi. We've got Adam. We've got Adon, Oscar, G-Man, Burn Survivor, Mike, and Mel. Not just Mike, not just Mel, but we got them both. Chris is here. We've got Kevin. Shamir, of course Shamir is here. Once again, where else would my man Shamir be on a Friday night? This is the best place to be. Best party in the country is the Dividend Happy Hour. And unless I'm sick or on vacation, it's going off every week. Julius Caesar is here. Thank you for joining us. We've got Dominique. We've got Suzuki Man. Will's here. Phil's here. We've got Kama, a.k.a. the other Chris, or maybe where is he? Maybe Chris Parciano is the other Chris. I don't know. There's a couple Chris's in here. We've got Kevin, Craig. There's a couple Kevins in here too, actually. Andy's here. We got Leif, D Media. What's going on? We've got Rex here. Adam. I think I already said what's up to Adam. Fast Eddie's here. Good job. Good stuff. Lucas is here. Felix, who picked up a little KRC. Good for you, my friend. Good move. Bing Bong is in the building. Nieces and nephews. TCAF. My man Jack Murphy. My other man Todd Cole. Stoner's Jim is here. Man, we've got such a good turnout tonight. My man David Clark is here. Journeyman in the building. Anthony. Yeah, we've got a really, really good group. Guys, thank you so much for tuning in. Kevin Burgess, good to see you. William Fletcher. Swampy Mears. Good Tunes. Andrew Morales, good to see you. Tommy, man, the list goes on and on. Ryan, good to see you guys. So let me go through some of these. Purchases real quick. Just see what you guys picked up this week. I see you guys already sharing like how your portfolio is diversified. That's awesome too. And I'm going to ask about that later on in the stream. But yeah, you guys are just one step ahead of me, I suppose. Let's see. And Oscar, this is actually a good question. What do you think of the Yield Max ETFs? Oscar, if you wouldn't mind, ask this question later on in the stream. I'd actually like to address it. Or maybe I'll just come back to it. But before the end of tonight, I'd love to talk a little bit about those because I've got a few thoughts for you, I guess. Let's see here. We've got Chris picked up some Realty Income and SCHD. Chris over here is drinking some iced tea. We've got Kevin with 1, 2, maybe 3 brewskis going on. Maybe. Shamir's drinking some Coke Zero. Good stuff. Always good choice. Averaging about $5 a day into the S&P 500 this week. Good stuff. Only thing that Phil bought was Altria Group. Very nice. We've got Leif drinking some Sprite Zero. I can't say I've had Sprite Zero, but Sprite sounds pretty good. I'd say that's one of my favorite sodas. I really do like Coke Zero. Dr. Pepper, Diet Dr. Pepper is really good too. I've always loved Mountain Dew. I haven't had Diet Mountain Dew, but I've always loved regular Mountain Dew. Grape soda I've always loved. Orange soda, one of my favorites. I've got to say though, my favorite soda of all time is, and maybe some of you guys have had it, some of you guys have not. Jones Soda. Do you guys know Jones Soda? Jones Blue Bubblegum Soda. Let me actually see if I can find it. Jones Blue Bubblegum. I used to drink this stuff all the time as a kid, and man, even just like thinking about it, I can like taste it. So let me show you just the bottle. You guys remember these? They have them in all different flavors, but these guys right here, I don't even know if this is going to be the berry, but they've got a blue bubblegum flavor that, in my opinion, is just to die for. I love it. But anyway, let's keep going. Kevin picked up some Seawin and Walgreens. Very nice. Looks like D here started a new position in VLO and picked up some more shares of Maine, Stag, and Texas Roadhouse. Very nice. Drinking some Mogu. I actually am not familiar with that. That sounds interesting. Rex bought some SCHD, Union Pacific, and Realty Income. I see G-Man picked up some BST. Adam had a couple nice purchases right there. Let's see. Oh, very nice. Andy is on a 4-hour hike. So I'm listening as I'm hiking and I have H2O. Good for you, Andy. That's awesome, man. That sounds like fun. What time is it where you're at? It's getting kind of late out there. Hopefully it doesn't get too dark on you on your hike. Let's see here. Ooh, very nice. Sipping on a Santa Fe 7K IPA and continued grabbing Vici, all the REITs, Realty Income, Stag, and some more AMT coming up this next week. Okay, and then Lucas locked in some gains on Tesla, is drinking some water and eating some popcorn. Yeah, very nice, man. El Dynamico's from West Sacramento. I didn't know that. I used to live in Natomas, and I think Rex, correct me if I'm wrong, I think Rex is in Roseville. So El Dynamico, we used to be neighbors. That's awesome. Wish I would have known before I moved. Let's see, good pickup here from Burn Survivor. 4 shares of Kroger before its ex-dividend date. Very nice. Cool little milestone from nieces and nephews. Picked up some Leggett & Platt, Walgreens, and Verizon. I definitely know those last two are pretty cheap. I haven't looked at Leggett & Platt for a while. Got to $1,300 per year in income. That's great. Good job. Cool little milestone. Let's see. Let's keep going. Oh, Kevin's got a little Corona. Picked up some SCHD. Very nice. Oh, Rex has a couple little milestones here. So hit 2 milestones. $3,000 of annual dividend income. Wow. Good stuff, Rex. And 200 shares of Realty Income. Dang, man. That's quite the position that you have in Realty Income. Good for you, my friend. Very nice. Okay, Dominique's started a position in Vici and to celebrate poured herself a glass of Bordeaux. So sounds delicious. Let's see here. Let's keep going. Oh, good job. Leif also hit $100 in monthly dividends with the account this week. That's fantastic. Really cool milestone. Officially in the 3-figure club, so good job. Let's keep going. We'll go through a couple more of these guys and we'll get into the main event. And for those of you who are just now kind of tuning in, we're going to be trying to answer a very common question that I get on my videos. I get a lot of emails about it. You know, how many stocks should you have as a beginner or just as an investor as you make your way throughout your investing journey? How many stocks, like how should you diversify your portfolio? We're a couple more of these. Ryan here, very nice words, Ryan. What's up? Love your content. Driving from Florida to Boston right now. Well, have a safe trip, my friend. That I can't imagine that being a super quick drive. Let's see. The up and down the state of California is like maybe 8 or 9 hours, maybe 10. So, man, you might be looking at I don't know, I guess depending on where you're at in Florida, you might be looking at a 12, 14, 16-hour drive. I don't know. But not for the faint of heart. I know that much. Adam here, good question. Let's talk about this after we get through the main event. I'll talk about that. just to remind me. Let's see here. Oh, guys, we got to welcome Goo to the first happy hour. Goo, good to have you. I hope you enjoy this one. We do this every week. The last couple of weeks I've been slacking. I was on vacation. I was sick. It's been kind of a wild couple of weeks for me, guys. So missed the last couple of weeks, but typically we do this every Friday night at 5 p.m. Pacific time, 8 p.m. Eastern time, and we have a lot of fun here. So really love doing this. But let's see if there's anything interesting out here. Andrew's also a first time to the Dividend Happy Hour, and I'm sorry, guys. You guys can see the lighting starting to change here. It's been really cloudy and overcast in Vegas, like actually pretty much all this week. It rained a couple of times. David, I know you know, Dave. It dumped here yesterday morning. It was like the opening sequence from The Day After Tomorrow. It was crazy. One of the hardest rains I've seen in a long time. But it's cool. I kind of welcome it. It's kind of a nice change of pace from the heat. But the sun's peeking back out right now. It's probably going to mess up the lighting here for the live stream, so I apologize. But anyway, Andrew's also first time here at the Dividend Happy Hour. Much respect for the efforts. Added CVS this week. Very nice. CVS is looking pretty cheap. Let's see here. Anything else before we get going? JC, also first time here. First-time joiner, welcome to the Dividend Happy Hour, JC. Are you still happy buying Williams-Sonoma? Yes, I bought some more Williams-Sonoma this week. And actually, if you guys want to see whatever I'm buying on a weekly basis, I know I share with you guys every month in the portfolio update videos, but every single week in my email newsletter, I'm sharing my purchases, I'm sharing which dividends I received, I'm sharing with you my weekly income, my monthly income to date, and also my annual income to date. All of that information is in my weekly email newsletter. I don't know if there's a link to it in the description of this live stream. I probably should have put it in there. I think it is actually. If you just go, the first link's going to be like a link to get my free dividend portfolio tracker, which you should check out anyway if you're not already using it. So definitely click the link in the description. But upon getting the free portfolio tracker, you'll also be signed up to my free weekly email newsletter, which I thoroughly enjoy writing. I love having that newsletter, and so I'd love for you guys to read it. Hopefully a lot of good information. If nothing else, you'll get to stay up to date with my portfolio and what I'm buying, but or selling in some cases, especially recently. Let's see here. Anyway, let's see, guys. One more thing here. One more. I see you guys talking about Jones Soda. I got to read those comments, and then we're going to get into it, I promise. No more lollygagging. So, Po Boy just crossed a dividend milestone, $200 per month. So, $2,400 of annual dividend income. Awesome. Collecting that sweet, sweet cash flow. Thanks for the encouragement. Good for you, man. That's a really cool milestone. That's the next one on my list. If I can hit $2,400 of annual dividend income by the end of this year, I'll be so stoked. We'll see if we get there. It'll come eventually, but yeah, that's an incredible milestone. So great job. Okay, guys. So I see a few good comments about Jones Soda. That's exciting. So why do we get into it, guys? I'm gonna hide the comments for now. Oh, here we go. Oops, I lost the comment. Last one. Sharon finally made it to the Dividend Happy Hour from Melbourne. Melbourne? I don't know how you pronounce it in Australia. I think you guys say it a little bit differently, but welcome to the Dividend Happy Hour. I'm stoked to have you, but I'm going to hide the comments for now, guys. We are going to get into it. So once again, in case you missed it, the first couple of times I mentioned it, something like this is one of the most common questions that I get. Common questions, common emails, common comments, whatever. What's the reasonable number of stocks to have in a portfolio as a beginner? Essentially, in other words, how many stocks should I own? Like, how many different positions should I have in my portfolio? And it's a really complicated question to answer, but in short, it depends. There's a few things to consider when trying to answer this question, but overall, it depends. And as Mr. Zack Attack said, I actually want to go all the way back. This is kind of the short answer, back to the beginning before the stream started. He had a comment on it. There's not a right or wrong answer. It's how many you are comfortable with. And that's certainly part of it. That's certainly one of the things to consider is, especially if you're buying individual stocks, how many different positions at one time, how many Coca-Colas and Pepsis and Procter & Gamble's and Realty Incomes and Main Street Capital Corporations, how many individual companies can you realistically manage, keep track of, and stay up to date with? How many quarterly earnings calls can you listen to? How much time do you have to devote to paying attention to all the companies in your portfolio? If you're investing in ETFs, which we're going to talk a little bit more about, it's not as big of a concern. But if you're an individual stock investor, if you're someone who's actively selecting stocks for your portfolio, it's important that you stay up to date with all of your holdings. And, common sense, but the greater number of holdings you have, the more time you're going to have to spend keeping up with all those. So it might get a little bit complicated. But in addition to just the time management and the mental space that you have for all the different holdings, here are a few other factors to consider. I mean, we kind of touched on this a little bit. Are you an active or a passive investor? Okay. Are you someone who invests in just mutual funds or ETFs? We'll just, for the sake of simplicity, refer to ETFs, just ETFs. So when we talk about passive investing, do you just have ETFs? Do you just have individual stocks? Do you have a combination of the two? Where do you kind of fall in that spectrum? That's definitely one thing to consider. And sometimes too, guys, we'll get more into that, but sometimes too, that's not something when you're first starting out as a brand new investor. You don't quite know the answer to a lot of these questions that we might be talking about. So it's something that you might also have to learn and understand about yourself as an investor as you kind of get the ball rolling, if that makes sense. So just and that's going to be the case with a lot of the things we're talking about today. So just keep that aside or in mind as a sort of asterisk to all of this. Okay. The second thing is, what sort of stocks and funds are you buying? If you are either or, if you're an active or a passive investor, what sort of ETFs are you buying? What sort of individual stocks are you buying? How predictable are the cash flows if it's an individual stock? How reliable are the dividends? Either way. So what sort of stuff are you buying? And we'll talk a little bit more about that as well. And the third thing is, how big is your portfolio? Are you someone, I know we've kind of talked about this in the context of a brand new investor so far, but assuming you're going to be investing for a long period of time, your portfolio is going to get bigger in size as time goes on, which is a good thing. It's a good problem to have. But how big is your portfolio? Are you someone who, like, let's say hypothetically, you invest in individual stocks and you have 60, 70 different holdings in your portfolio? Does that make sense if you only have a couple $1,000s invested or $10,000 invested? Does it make sense to have 70 different positions? I don't know. We're going to talk a little bit more about that as well. And then on the inverse of that, maybe as your portfolio size gets bigger, then maybe that's something to consider too. But anyway, these in addition to just how much mental space you have for your positions are things to consider. Now, diving into all of these, I mean, starting with the first one, are you an active or a passive investor or somewhere between the two? Starting with being a passive investor. If you're someone who just invests in ETFs, if you just want to go the ETF route, be as hands-off, as passive as possible, I really don't think you don't need that much, okay? You need maybe one ETF, maybe two. I'd say 2 to 3 at most, but on this screen here, we're only covering up to 2. And these are all, some different scenarios that you maybe could consider. If you want to go the passive route, just ETFs, these are what I think are some pretty good combinations of ETFs. I mean, if you just want one, you could just make your whole portfolio of VTI. You could make your whole portfolio of VU. You can make your whole portfolio. I think there's an argument to be made for this. Some of you guys might disagree, but I think you could have your whole portfolio be SCHD if you wanted to, over 100 different holdings. Same thing with VYM, over 400 different holdings in that ETF. DGRO, another great fund. I think you could probably make, just put all your eggs in that basket. Same with VIG, which I think has over 300 different holdings. So even though there's just one thing you're buying into, they're all very diverse. I mean, VTI's got thousands of different positions. VU has hundreds. SEHD over 100. VYM hundreds. DGRO, I don't know. I don't remember off the top of my head exactly how many that has. But, if you don't feel like one is enough, then go 2. Maybe a good combo would be SCHD or VYM because I think they're kind of similar. You could do one or the other. That plus VU, same thing. SCHD or VYM plus VIG. I think that's a pretty good combo. SCHD or VYM plus DGRO, same thing, pretty good combo. And then you got the last two there, DGRO plus VU, great combination. DGRO plus VIG, fantastic combination. I think you could get away as a passive investor just doing something like this and keeping it very simple. I don't think you need to have, and I see this sometimes too. I see some people, they'll have like 7 or 8 different ETFs. And personally, I think it's a bit overkill. I think you can get by with just 1 or 2, really. So keep it simple. So anyway, that's what I think if you are just a hands-off passive investor, go in the ETF route, okay? Now, let's say you want to take a hybrid approach. Let's say you want to have some ETFs, which is probably going to be a lot of us watching, right? A lot of you guys there in the live chat, a lot of you guys just watching this video right now probably are kind of in this camp. You know, you have maybe one or two ETFs as the foundation, as the backbone of your portfolio. You're casting that wide net and creating that instant diversification with those ETFs, but maybe you want a few individual picks. Maybe you want to, you want to try your hand at picking some stocks. I think that's totally fine. In this instance, in terms of diversification, I think same thing. You can get by with maybe certainly one, maybe two ETFs at most. I don't even know if you would need two ETFs. But let's say 1 to 2 ETFs and then maybe a few individual stocks above that. Maybe just your highest conviction picks. In this instance, I don't know. I don't know if you had, like VU or SCHD or something. I'll put them back on the screen in a moment because I've got a few options there. If you have something like that as 50 or 60 or even 70% of your portfolio, I don't think you need that many individual stocks, maybe 3, maybe 5. But this is kind of what that could look like in that instance. SCHD plus 3 to 5 stocks, especially as a beginner. Buy what you know. Maybe your Target, maybe you like going to Starbucks, maybe you do your grocery shopping at Walmart like I do. Maybe you like to get your home improvement on the weekend, so you grab a little Lowe's or Home Depot. Anyway, 1 or 2 ETFs plus 3 to 5 stocks. VU plus 3 to 5 stocks, VTI plus 3 to 5 stocks. And, we can go back to this list of ETFs over here. You could choose any of the following there on the left-hand side and add, 3 to 5 stocks to that. I think that would be a pretty good approach as a hybrid investor. And there's certainly nuance to this too, so don't take this as gospel. There's as I always say, I'll say this at least once, I think, in every of my live streams. There's more than one way to skin the cat. But anyway, that's kind of what I think as a hybrid investor, where you've got the ETF as the foundation for your portfolio, and you want to have some individual stocks on top of that. You want to have try making it a little fun for yourself in that way. And I think that's, like I said, a lot of us here. But anyway, moving on to the next one. Let's say that you are an active investor. An active investor being someone who solely invests in individual stocks. You no ETFs, no mutual funds. You are custom building your portfolio from scratch, from the ground up. Everything in there is hand selected by you based on the research that you've done into those holdings. You've determined that they're great ones to hold, whatever. You feel good about having them in your portfolio. But this one's a little bit more. There's a lot more gray area, I think, with this one. And I'll show you what I mean. Excuse the visual. I'm not the best artistically, but hopefully this can help paint a picture. So if you're an active investor, the individual stocks or funds, this applies to ETFs as well, especially with a lot of the ones that we see here in the dividend investing community, a lot of these income funds. Picking your holdings can fall on a spectrum of sorts. And I probably should have put some other ETFs probably on the stalwart side. But basically, guys, on this spectrum, you've got stalwarts over there on the right, just very steady, very predictable, very reliable companies or ETFs or whatever. We'll just stick to companies because we are talking about active investing. And I know I put TSLY there, so maybe that's a little bit cheating because it is an ETF. But anyway, then on the other side of that spectrum, you've got things that are speculative, maybe more risky, where the income and the cash flows aren't as certain or aren't as guaranteed, which is certainly the case with all of these. I mean, we've seen Zim cut their dividend. I'm sure they'll bring it back. AG&C over time has reduced their dividend. TSLY, they pay a variable dividend. And so that goes up and down on a monthly basis. But I think there's no denying that all three of those examples right there are certainly more risky and more volatile than what we would see. And furthermore, their dividends are not as dependable to come as something like a Johnson & Johnson, a Procter & Gamble, or a Coca-Cola. So there's kind of the spectrum there. And then, all the other stocks we can think of, whether it's an Intel or a Qualcomm or Waste Management or, you name it, Union Pacific, Texas, did I already say Texas Roadhouse, Starbucks, McDonald's, all these other different examples fall somewhere on this spectrum as well. And so as an investor, an active investor, you need to determine what the holdings in your portfolio, where do they fall on this spectrum? Do you have more that are, I'll go back to this, do you have more that are on the stalwart side? Do you have more that are on the speculative side? And if you are more towards the right of the spectrum, if you have more of these stable, sleep well at night stocks, then I think you can get away with holding less, having less holdings in your portfolio. I don't think you need 20 to 30 Johnson & Johnson's, Procter & Gamble's, or Coca-Cola's? I think probably, honestly, 10 to 15, maybe. Maybe, yeah, somewhere in that range. I think that's a very comfortable range. Now, on the other hand, if your holdings are more speculative, if you're going for those high yielders, we can call them yield traps. We can, we don't have to, but I'm sure there's an argument to be made for holdings on that side of the spectrum to be that. If you're going to go more that route and you're going to do a little more yield chasing, which I'm not judging if that's the case, but if that is the case, then you maybe want to cast a wider net, because the chances of those dividends being reduced or completely eliminated altogether are going to be, and some might even disagree with this too, but they're going to be higher than if you were to just invest in a Johnson & Johnson, a Procter & Gamble, or a Coca-Cola. And so you don't want to put your portfolio's overall income at that level of risk where you're concentrated into just, let's say, for example, those three. Yeah, let's actually do this fun little exercise. Like if you guys had to pick just, to one or the other portfolio, each one has three different holdings, A, G, and C, TSO, Y, and ZIM versus Johnson & Johnson, Procter & Gamble, Coca-Cola. I mean, which one would you feel better holding on to? Which one would help you sleep more at night? And I don't know. I think you'd be, no disrespect, but I don't know. I think you'd have to be a little bit crazy to choose the one on the left there. But, with that said, if you're going to go that route, you don't want to be so concentrated into those, because it's going to put your income, it's going to put your portfolio and your hard-earned dollars at risk. So I think you need to cast a wider net and probably have more holdings. Then I think it could make sense to get up to the 25, 30, 35 holdings if you really wanted to. And that might even be too much, but certainly more than you would need if you were just going the stalwart route, right? But anyway, enough rambling on this. The last, I guess, thing that it depends on is portfolio size. And this is a very rudimentary drawing. It's not perfect, but I was kind of touching on this earlier. If you have $2,000 invested, $5,000 invested, $10,000 invested, you probably realistically don't need to have 60 different holdings in your portfolio. And I know, guys, I know Mr. Zack Attack or someone else said at the beginning, Jason Fieber has 100 different holdings in his portfolio and he's very successful. That's true. That works fine for him. That's fine. As a beginner investor, someone who's just starting out, or even rather, if your portfolio is just on the smaller end, I don't think you need to have that many holdings. Now, on the other side of that, as time goes on, like I said earlier in the live stream, as time goes on and your portfolio grows in size, I think it's natural and probably actually a smart move to over time expand the number of positions in your portfolio. And that's what I try to depict here on this graph. As the value of your portfolio goes up, it could make sense to see the number of holdings in your portfolio go up as well. And the main reason for this, I think, is to just preserve, to play a little bit more defense. You have a lot more money at risk. And as time goes on, as you get closer to retirement, you want to protect not only the dollars that are in that portfolio, but the income that it's generating. And this becomes increasingly important as you get closer to retirement, get closer to being ready to live off that income, or even have made the transition into living off that income. I think you'd feel a lot better having a wider net, knowing that if something were to happen to one holding that you maybe have 1 or 2% in, it's okay. You're not, not all of your income's going to be gone. It's just a small portion of it. There's still all these other holdings that are keeping that money flowing and keeping you protected. So, and keeping you from having to go back to work. So that's kind of my take on the whole thing. Let me just look at my notes real quick. Yeah, that's more or less it. And just kind of some, I guess, closing thoughts real quick on all of this. Like I tried to say earlier, there's so much nuance. There's a lot of gray area to a lot of this, and nothing that I've said here should be taken as gospel. There's more than one way to skin the cat. Everyone's going to do it a little bit differently. And kind of to Mr. Zack Attack's point, or whoever was talking about Jason Fieber, a lot of it does come down to preference. But preference aside, if it was me, like, these are some of the factors that I would consider when trying to determine or trying to evaluate if I have enough stocks in my portfolio, too many stocks in my portfolio, or not enough stocks in my portfolio? These are some of the questions that I would go about asking myself when taking this audit of the holdings that I have. So that's my take on the matter. I see like 100 comments in the live chat that I've missed, and I want to go through those real quick. But real quick, guys, let me know. A quick question for you, answer in the live chat or in the comments below. How many stocks do you have in your portfolio? How well diversified are you? Let me know that in the live chat, and also let me know in the comments below. I'd be curious to hear. And I'm already anticipating we're going to have just a wide range of numbers there. It'll be interesting to see. But let me go back up, see what I missed here. I'm way behind in the chat, so let me see. Let's see here. Okay. See what I missed. And I'll get to all the comments. I'm just quickly scanning the live chat to see what you guys were saying as I was going through my spiel there. So let's see. I see Zal here. What's up, Zal? Hope you're doing well, man. Let's keep going here. 55. I want to get to 80 stocks. I'm comfortable with that. Yeah, Mr. Zack Attack stuck on Jason Feber here. No disrespect either, man. Do whatever you want to do. It's all about preference. Ooh, pizza. What watch are you wearing? This is nothing crazy. I just got this for my birthday from my mom. This is a Seiko 5. It's like a just not even $200 watch. Just got it on Amazon, I think. But yeah, I love it. It looks kind of like a day date, like a Rolex day date or something like that. But yeah, it's really nice. I wanted like a daily driver, as they call it. I've got a couple other watches, or one other watch, but kind of starting to build out the collection. And this one I figure I could wear every day. It looks nice, and it's not super expensive, so I don't have to worry about anything too crazy happening to it. And it's so like versatile, like it goes with pretty much everything. So let's see here. Josh here says the Star Wars analogy. What did I say? Did I say anything about Star Wars? If I did, I totally did not mean to. But what did I say? Maybe I did. I don't know. Stalwart, yeah. What did I say about Star Wars? It totally did not mean to. Let's see. I see Carlos here. Carlos is saying hi. Hey, Carlos. James says, one thing I'll say, you don't need to keep up to date on your stocks on a monthly basis. Failing companies don't fail in 3 months. Okay. Let's see here. That's the interesting thing. I'm just seeing so many differing opinions on this. Zack Attacks go more, the more the merrier. El Dynamico's, when you're a beginner, no more than 10 to 15. James is like, don't even worry about keeping up with your stocks. If you have to keep up with them, they're not good investments, basically. Let's see. Derek, 10 to 15 investments that you want to make, then work towards buying 100 shares of each. Josh, 12. Felipe is not Myron. USA stocks, they have poor dividends. Hater. Chris has 22 stocks and 3 ETFs. J-Lock, 18 stocks and 1 speculative play. Rex, SCHD, and 10 individual. That's not bad. That's pretty good. TCAF, 18 holdings. Okay. Leif here with 20 holdings. Okay. Wong, I have 5 different stocks, $110,000 portfolio. Okay. Wow. Okay. So like this no, I don't mean to like call you out, Oscar, but that to me looks like too much. I don't know anything about your portfolio, but I look at that and be like, yeah, there's got to be some room to consolidate. Not that it's fine if you don't, if you enjoy all the holdings, that's fine, but yeah, I don't know. Let's see. Phil's got over 40 holdings. Sharon around 15. Nieces and nephews 36, but only DCAs into 20. Stoner's Jim 23 holdings. Suzuki Man 19. Chris 16. Infuse 5 with a 50% allocation in one of them. Which one's the one with 50%? I'm curious. Let's see. Slim Bay. So this is a good example. I have about 65 and a beginner, so portfolio is trash. I mean, give yourself some credit. Your portfolio is not trash. The important thing, honestly, the important thing is that you're just investing. And having said all of this, guys, one important thing to keep in mind too is, especially as it pertains to dividend investing, and this was something I probably should have mentioned earlier, but this is also like another huge asterisk to all of this stuff, is that at the end of the day, if you're investing for income, not saying you should just invest strictly for income, but a lot of us have the intent to someday live off our dividend income, right? So if that's your goal down the road, at the end of the day, like a dollar coming from one holding is going to be the same as a dollar coming from one holding. So it at the same time, even if you have 65 and they're all cash flowing, it's like it's still not the biggest deal. It's still not. So whether you have, like, I guess another way to word that, or a better way to word that, is if you have $2,000 coming in every single month, it doesn't matter necessarily if that's coming from 5 different positions or if that's coming from like 20 different positions. It's still, it's $500 coming in that month. So I guess the dollar amount's kind of what's the important thing. So, oh, Dean says watch is cool. Thank you, Dean. I appreciate it. Yeah, it's I haven't got to. I don't know if my mom's watching right now. I tried to call her earlier and tell her thank you for it because it just came today, and but I love it. I'm like probably never gonna take this thing off. Like I said, this is gonna be my daily driver. I'm gonna wear this all the time. Let's see. Oh. Okay, Lucas, stalwarts, not Star Wars. Yeah. Yeah, that makes more sense. Okay. Um, yeah, I've been seeing a lot of chat tonight about these yield max ETFs. Let's talk about it real quick. So, I actually made a video a few months ago now on TSLY, and I think I made the video. I don't remember exactly when TSLY. Let's actually look. Let's go back over here to our Jones Soda. Let's get out of this. So I don't remember exactly when TSLY came onto the market. It was sometime earlier this year, I believe, right? If we go over here, it'll show us the dividend history. I've been saying a lot too. I just realized that. So it looks like their first dividend payment was in January. So at the very start of the year. Now, when I made the video, they had just announced this dividend payment right here. So 4 months into it, in their 5th month, the dividend had been trending down and down. And I think I made my TSLY video right after this happened. And since then, it's gone back up, which is not surprising. That's how these things work. It's a variable dividend paying ETF. So it's a variable dividend, excuse me. And so it's natural that it's going to go down and it's going to go up. And now it's starting to kind of go down a little bit again. So it just kind of ebbs and flows, right? And I've gotten a lot of comments on that one video as soon as like the payment started going back up, saying like this didn't age well, just kind of, not very nice kind of comments disagreeing with me, I should say, which is fine. The thing about these yield max ETFs is that, at least with TSOY, because that's really the only one I've looked at. So they employ what's called a synthetic covered call strategy, which I don't quite understand. It's a pretty complex thing, and I believe it's when something like they buy. They don't actually own. Oh my gosh! See, I'm not even going to get it right. They don't actually own the shares of the stock that they're selling covered calls on. So in TSOY's case, they don't actually own Tesla shares to write the covered calls. What they do is, I think they buy puts on Tesla while simultaneously selling calls, or maybe I have that backward, but they kind of do the inverse of one another. And what that does is synthetically replicate ownership of shares of the stock that they're writing call options on to generate that premium. I'm sorry if this is getting confusing. It is confusing stuff. But that's why new investors should not invest in those, because they're very hard to understand, number one. Number two, they do pay that variable dividend, so it's going to go up, it's going to go down, and funds like TSOY, and I know there's now NVDY, the one for Nvidia, looks like the ARK ETF version of it, the Apple version of it, and so there's a few different stocks that they're doing this with, stocks and funds, and they're all so new that we don't know the long term what these distributions are going to look like and where they're going to level out. But the thing is, a lot of investors just see this right here, the 45% trailing 12-month dividend yield, and they're like, oh, I can make all my investment back in, like, I guess a year, well, 2 years, 2 years, 2.5 years, something like that. Which may be true if the dividend holds steady, and I will say the share price movement so far has not been bad. But once again, things could change. Things could change, and these are proving to be pretty volatile. It seems like there's a lot of up and downs with them, which for a new investor can be quite concerning. You don't want to. A lot of investors get spooked when they see. I mean, they get excited when they see big jumps in share price, but the opposite when they see big drops in share price, which does seem to happen with this, at least with TSLY. And as we've seen with the distributions, they go down pretty rapidly, but they also go up pretty rapidly. So it's a lot of up and down, a lot of volatility, and that's just something that the brand new investor doesn't really need. And furthermore, I'm not sold, and you could make the same argument for things like JEPI, JEPQ, QYLD, XYLD, RYLD, all the covered call ETFs. I'm not necessarily convinced that any of these are suitable long-term investments, ones that you should rely on and put a lot of your eggs into those baskets in your portfolio. I just don't think it's something you should make a huge part of your investing strategy. Now, like I said earlier, just in terms of diversification, if you want to give it a shot, if you want to try and capitalize on some quick, very aggressive cash flow with these yield max funds, then try it out. I mean, I don't think they're that expensive. If we go back over here, I mean, TSLY, one share of it's less than $15, so it's not like it's breaking the bank at all, But I would not make it a huge percentage of your portfolio. And this is kind of where we're going back to talking about casting a wider net. If you're gonna try your hand at more of those things, then just buy more. Just cast a wider net, so you're a little bit more spread out at least. You don't want to put all your eggs into that basket. So it's just not a good long-term strategy. Let's see here, and that's how you need to think too. Like, you need to think long-term. You need to try and be able to think past 1 year, past 2 years, past 5 years, more so, and it's tough. Think in terms of 10 years and possibly for the rest of your life. As a buy and hold investor, that's kind of I would say shoot for a minimum of 5 years or 10 years when you're looking at these stocks. It's a little bit easier when you're going with the ETFs because they're so diversified, but with individual stocks, it's or even these more speculative funds like TSOY, it's a bit different, so different rules apply. Let's see. This is a good question from Joey, who says, if you could start again, would you go for growth to build up a dividend cow? Never heard that phrase before, but I kind of like it. Or would you go with mostly dividends again? Yeah, this is a really good question, Joey. I'm actually going to screenshot this because maybe I'll make a video out of it at some point or something like that. So when I first started investing, I've pretty much always gone the individual stock route. Once I started taking this stuff serious, and if I could start again, and well, actually, before I get to that, what I did was I cast a pretty wide net. I pretty much did what I don't think I would do again, which is buy a ton of stocks without doing individual stocks, without doing a lot of research. And then I ended up selling out of some of those, like doing quite a bit of rearranging in my portfolio till I kind of found my groove and kind of started to learn more about this stuff, So there's a lot of trial and error when I first started. And if I could start again, just in terms of growth, just in terms of how I diversify my portfolio, I'd probably consider doing the hybrid approach. I probably would do something like SCHD and then maybe pick 3 to 5 holdings on top of that and then build it from there. If I could go back again, that's maybe what I would do. But I really do love having individual positions. I feel like 3.5 years into this game, I feel like things are starting to click and I'm starting to understand this stuff better. It takes some time, and it's an infinite game. It's one that you're constantly going to be a student of, which is the fun part. But yeah, it kind of takes a while to really, I guess, learn the ropes and find your groove. But it's cool. But anyway, to really answer your question, if you could go back again, would you go for growth to build up a dividend cow or go with mostly dividends? No, I would stick with dividends. I love this style of investing. This scratches the itch for me. I don't feel that I'm someone who needs to see like a 10 bagger in my portfolio. If it happens, fantastic. I certainly would welcome that. And I have a couple positions that are doing very well just in terms of share price appreciation, and it's cool to know that they have appreciated and stuff like that. But it's not my main thing. Like, my main goal is to live off of the income. And to your point, like, I could go growth and try and go for share price returns and transition that into dividends. But I don't know. I'm okay cutting out the middleman and just going with dividends from the get-go. And I'm still benefiting from share price appreciation. So it's not like I don't feel like I'm missing out on that. And I feel like I have a really good balance in my portfolio between generating solid income and also being able to generate some pretty decent share price returns, at least so far. So let's see. But really good question. Thank you for asking. Let's see. The Ghost of Toby. Joseph Hogue said we're all doing this wrong and we should be investing in growth stocks, then converting it into dividend stocks. Why is he a hater? I don't know if he's a hater. I mean, I like Joseph Hogue. He's got a good channel. There are a lot of dividend haters out there. There's just in general, you guys will find there's a lot of people who like to, I don't know, I guess like to talk down on the way that other people invest. As I have said numerous times in the stream, think there is more than one way to skin the cat. I think if you're looking to build wealth, there's certainly more than one way to do it, and you need to find the way that's suitable to you and is one that you get excited about and can adhere to. I know that's the case with dividend investing for me. It may not be the case with Joseph Hogue, and I haven't heard his argument as to why that is, but I would imagine part of that argument has to do with taxes and dividends being essentially double taxed. The dividends or dividends in general being tax inefficient. Because when the dividends paid out to you as a shareholder, it's already been taxed at the corporate level, and then it's taxed to you on a personal level. You pay income taxes on the dividends you receive. So you're kind of double dipping into the taxes there, which is not ideal. So that could be one reason he's talking about it. And he could also think that, and this may be true depending on which stocks you invest in, which growth stocks you invest in. His argument may also be that you will, like, let's say hypothetically, your goal is to generate like $40,000 in dividends per year, right? Well, if you had $1 million invested, that means you would need a 4% dividend yield to be generating that income. Just some very simple math. His argument might be you're going to get to that $1 million a lot quicker if you invested in more growth stocks and then got to that $1 million portfolio value and then converted it to more dividend stocks to reach that level of income. That could be part of his argument as well. I just don't know because I haven't seen what he's talking about. But yeah, there's a lot of people that like to rag on dividends for being a slow way to invest, being tax inefficient, irrelevant. There's the dividend irrelevance theory. So there's a lot of negativity surrounding dividend, and it's important to keep in mind too. Like, I'm not saying that any of those people are wrong in the things they're saying. There's certainly some truth to a lot of that, but no situation's perfect. And there's different risks with different styles of investing. There's different upsides and there's different downsides. Real estate has its own set of risks and upsides and downsides. Growth investing has its own set of risks and upsides and downsides. And dividend investing has its own as well. I don't think that's lost on a lot of us dividend investors. I don't think that's lost on a lot of us dividend investors. We're aware of the taxation. We are aware that dividends aren't guaranteed. We are aware that the share price goes down after the ex-dividend date by the amount that you are going to be paid in that dividend. We understand these things, but still, at least speaking personally, the pros outweigh the cons for sure. I get so stoked getting that passive paycheck and knowing that this time next year the paycheck's going to be larger than it was before, and then that's going to be just a vicious cycle that never ends. That's the dividend snowball effect right there. And furthermore, knowing someday that I'm not going to have to sell shares of my stock to be able to benefit from these assets. I can hold on to them and they can continue to pay me into oblivion, and whoever comes after me will be able to benefit from that as well. So, and this isn't for everyone. That's understandable. But I also don't know that not that saying that Joseph Hogue was doing that, but I have seen a lot of that, especially lately. Just other people talking bad about how others invest, and even when it comes to the yield max things, like that's not my cup of tea, and I try and discourage beginner investors from going down that route. But at the same time, I mean, number one, I could be wrong. Number two, try it out, learn for yourself, and make your own judgments based on that. So we always talk about YouTube, people just buying things that they see people talking about on YouTube, but I also don't want necessarily the inverse of that to be true. I think the inverse of that is just as bad. People not buying things or people not selling things just because they see someone on YouTube talking about whatever it is. And so I think there's just so much about this that you have to learn for yourself, and that's kind of where the fun is, So anyway, enough rambling. I'm like 15, 16 minutes behind in the chat. I got to get caught up. Yeah, caught up to the live, and Ryan sounds drunk again. No, dude, I'm totally clean right now. No alcohol. I'm actually pretty tired. I'm not gonna lie. I've just been tired these last couple of days. I don't know if it's the heat or it's not been sleeping as well or whatever it is, but yeah. So, Josh says, "Don't wear a hat anymore." LOL. Got a lot of hype about that, huh? I don't know what you mean. I wear a hat sometimes. If that comment was for me, I wear a hat sometimes. I don't wear them too often, but it's got nothing to do with what other people think about me wearing a hat. I've had people comment about me wearing a white t-shirt and giving me a hard time about that. It doesn't matter. Let's see. Let's keep going here. Sorry, guys. I'm just getting caught up in the chat now. So, Kevin here. This is a good question. So, do you have, my brother Ryan, I love it, man. Do you have daily buys in your portfolio, or do you lump sum invest? Which would you recommend for a dividend portfolio? So I invest every single week into my portfolio. The day varies. It's just kind of whenever I get around to it. But I've got money going into my brokerage account every single week, and I'll usually buy one day per week. So no daily buys, not really lump sum investing. It's dollar cost averaging into the portfolio, and then what I buy every single week kind of varies as well. But as far as what I would recommend for a dividend portfolio, I think that I don't know if there's a right answer here. I know some people who like to do daily buys, and I can see why that'd be exciting. So maybe try that out if you want to. You could do weekly buys, you could do monthly buys, you could do annual buys if you want to. I think the important thing really is just being consistent in whatever capacity you want to, but consistency is so huge. It's just kind of like going to the gym too. Like, you don't just go to the gym and work out once and then you've met your fitness goals. It's something that you have to do over an extended period of time, and it's something you have to be consistent and disciplined with. So the same is true with investing, but the frequency, there's a little bit more wiggle room with this than there is with with working out. Like you can't just go to the gym once a month and expect to make serious gains or anything like that. But you could do that if you wanted to with investing. So that's kind of my take on the matter. Let's see. Let's keep going here. And just a heads up, guys, we've got about 5 minutes left in the live chat, and then we've got about 5 minutes left in the dividend happy hour. Then we are jumping over to the after party. But one question from Commander Blaster: how many shares of each would you stop at with 5 stocks before adding different stocks? Ooh, that's a really good question. How many shares of each? I don't know that there's an exact number of shares. But I don't know. I actually don't really know how to answer this question. I think when it comes to adding different stocks, I think if you see a better opportunity outside of your portfolio and you want to add a stock, then maybe just do it. Maybe don't worry about the diversification at that point. Maybe just start that position and build that up while it's at a good value, an attractive value. And you've maybe weighed the opportunity cost and you've decided that position that you didn't have before was a better place to put your money. Just start buying that. And then, figure out how the exact diversification later. Kind of maybe not the best or most coherent answer, but that's kind of the best one I got for now. Sorry, but that was a good question. I'm going to think a bit more on that. Let's see. Keep going. Okay. This is a really good question. So, do you have any, Shamir, I see your comment about cats. Do you have any advice for saving money for kids? I have a 2-year-old, 529B. So, this is a really good question as far as saving money for kids. I'm not the best person to ask because I'm not a parent myself, but I guess a good rule of thumb is just that it's never too early to start saving. It's never too early to start investing for your kids. I know when I was when I was 11 or 12 or somewhere in that range, my parents started a custodian account for myself and my siblings. And that custodian account is the portfolio that I still contribute to now. So it ended up being a really good thing for me. And like I said, I just don't think it's ever too soon to start with that, start investing and setting aside money for your kids and hoping that when they come into it, when they get old enough, they'll kind of catch the bug and treat it responsibly. So I don't know. That's a tough question. Like I said, I'm not the best person to answer because I'm not a parent, but I think in general, it's never too soon to start saving and investing for your kids. So. Yeah, Michael, this is exactly it. Every time I talk about the ways to skin a cat, everyone has to take a drink. Yeah, we need to, someone needs to come up with like a drinking game for these dividend happy hours because there are some recurring themes like that, the skin the cat thing. There's got to be some other ones too. Like what are some other things that happen often here? You guys let me know. It's probably things that I don't really realize, but then once you say it in the live chat, every time it's like I'll be self-conscious about it. Every time I'll be like, oh, there I go again. But yeah, we need to come up with some sort of drinking game. Honestly, I would play too. If there was some sort of like drinking game. Okay, here's what needs to happen. Someone needs to help me come up with some rules for this drinking game. I'll make like a downloadable PDF and I'll put it like in the description of the video, and then we can follow along as we do these dividend happy hours. That'd be awesome. We need to do that. That's a good idea. Let's see here. Oh, this would be another one. Like if I talk about KRC, that's got to be on the list as well. I haven't really talked about KRC today, but I am officially in the green with KRC now. So yeah, I mean, dividends aren't guaranteed. I know. It's like I thought the dividend policy was forever. I know. I will say this, like dividends aren't guaranteed, but they are a bit more guaranteed than any sort of share price returns. Like until further notice, until they cut the dividend, it's there. So let's see here. Yeah, Dominique, this is a really good question. Are you keeping cash aside in a high yield savings account to benefit from the dips, or do you invest it all? Currently at 15%, but I'm wondering if it's too much. Yeah, I don't know. I'm trying to think about how to approach this. I do have a high yield savings account that I contribute to every month. It's more so just used as like a vacation fund that I'm saving up for. So that's pretty much it. But yeah, I don't know. I don't think 15% in something like that's bad, but yeah, I don't know. I guess what are you waiting for with that cash? Are you just waiting for like a big dip and then you'll use that cash to buy stocks, or what's the plan with that? Yeah, Dean, thank you so much for saying this. Great topic. Love to see all the different opinions. Yeah, absolutely. There's so much it just goes to show like there's really no I'm not going to say it. I'm not going to say it. I don't want you guys to have to keep drinking, but it just goes to show there's really more than one way to do all this investing stuff. So it is interesting to see all the different opinions. And it's good everyone has their opinions, and is like that just goes to show you guys are thinking for yourselves and have your own thoughts on the matter. So I like to see that. So Zal, what if my fitness goal was to go to the gym once? Well, then, my friend, I think you need to reevaluate your goals. No disrespect. But anyway, guys, we're going to wrap it up here in just a moment. Going to just see. Maybe there's like one or two last comments. Let's see here. Drinking game for skinning the cat, yeah. So Josh, I did a video. If you just go type in TSLY, or just go to my channel, type in TSLY. I think it's the title of the video is TSLY a scam? Just search that on YouTube. You'll see my video on it. Whatever my thought is for TSLY is going to be my same thought for probably all of the other covered call ETFs or the other yield max ETFs. So I'm kind of just gonna right now lump them all under the same category. So Shamir, would love to see you debate with Darth on Zim, as both of you seem to have opposite viewpoints on that stock. I mean, to be honest, I get it, Shamir, that would be interesting, but I'll be honest, I have no interest in doing that. I really have no interest in like having debates about stocks and like trying to prove Darth wrong or have him try to prove me wrong about it. I'm really just not interested in that. I really don't care. Like Darth's a good friend of mine. Darth's going to do whatever he's going to do, and I'm happy for him. His income's going to grow just as mine is going to grow. He has Zim, whether he doesn't have Zim, he's going to be fine. I really don't have any interest in debating people on certain stocks or investment theses. It's just, to me, that doesn't seem like fun. It doesn't seem like a productive conversation, and I just don't care about being right about those sort of things. It's not something I'm interested in. So okay, guys, I think this is a pretty good place. Let's see. Darth hasn't met a stock he doesn't love. Darth's a man. Darth's a good dude. I love Darth. Anyway, guys, I think this is a pretty good place to wrap it up. I just now got all caught up with the comments, but yeah, I think this is a good place to wrap it up. I'm seeing a comment about 3M. Yeah, so Dorian, I seen a couple other comments on 3M. I put out a video on 3M just this last Sunday, so it answers a lot of the questions that I've seen about 3M here in the live chat. I answered in that video, so definitely check that out. If you have any further questions on it, though, we're going to wrap it up right now, but feel free to shoot me an email or circle back with me next week when we do the happy hour, and I'd love to address it. But guys, like I said, I've been trying to say, we're going to wrap it up here. Really fun stream tonight. I was so excited to be back for the Dividend Happy Hour. Definitely tune into this Sunday's video. This one, I'm pretty excited about it. Like, it was kind of, honestly, I'm not going to give it away. I'll tell you in the after party, guys. You already know, actually. But this video was actually kind of a big deal for me. And I don't know how you guys are going to feel about it. It was something that I was really excited about. And I'm looking forward to sharing it with you guys. But please tune into my video this Sunday, going out this Sunday. Like I said, for me, it's kind of a big deal. You guys, there's definitely going to be some mixed thoughts on it. I already know. But yeah, I'd appreciate it if you would tune into this Sunday's video. Put it on 2x speed because it's a long one. And let me know what you guys think about it in the comments. And also, once again, guys, sign up for the weekly newsletter. I've been going hard with the newsletter, really trying to make that thing as fun to read and as cool as I can, and been really putting a lot of hard work into that newsletter. And I think you guys would enjoy it and get a lot of good information out of it as well. And if nothing else, you can stay up to date with my weekly buys, my weekly dividends. So definitely sign up to the email newsletter. If you'd use the link in the description below for the free portfolio tracker, you'll get my free portfolio tracking spreadsheet along with that, which it's been downloaded thousands and thousands of times at this point. I'm just so like, I'm at a loss for words, apparently. How much good love I've gotten on that spreadsheet. Good love. So you guys check that out. You'll get you'll be able to read all the newsletters as well. And you guys, thank you so much for a fun live stream. It's good to be back in action. Cold classic, Red, White, and me on the Dividend Happy Hour. And I'll see you on Sunday's video. Please, for the love of God, tune in. And I hope you guys have a fantastic weekend. And I will see you in the next one.